We're talking STR analysis. Whether you're an experienced host, you know exactly what we're talking about, and if you don't, today we're talking about short-term rentals. Short-term rentals are 30 days or less leases. The two largest platforms are Airbnb and VRBO, and we're going to break it down for you here today. We're talking general STR analysis. Whether you're new to short-term rentals or you're an experienced owner, management, or co-host and struggling to make money, we're going to go through the 4 benchmarks that will help determine whether a property is viable or not. Number 1, and most importantly always, is understanding the local laws. So it's all over the news all the time. It happened in New York, it happened in Dallas, but laws are constantly changing. And before you need to start underwriting or looking at the numbers or comps, you must understand the local laws. Number 2 is the revenue side. Now, before you start doing any kind of underwriting or looking at back of the napkin math, number 1 metric to look at, that I always look at, is 20% gross ROI. So in its very simplest form, if I had a $500,000 property, the gross revenue needs to be $100,000. If I'm not achieving that, I move on. So this way you can rip through deals and you should be able to do 10 a day. Number 3, we look at our debt. Now, debt a couple years ago used to be easy and you could underwrite, and now things have radically changed. And people are still saying, well, you should underwrite like it could survive as a rental, long-term rental, so 12 months or more. That is no longer the case. So there are 2 ways of doing the financing. There is institutional or creative. Creative, we mean subject to, it could be seller financing. And institutional is you walk into the bank and you get a mortgage. Now with that comes tax returns, financial covenants, guarantorships, and those rates are 7, 8, 9%, and it is very difficult to underwrite. But you need to understand the debt piece next as well. And number 4, the 4th pillar is your expense side. So what we do, one of the things that we do at More Properties is we do third-party management for owners. Typical market third-party management is anywhere from 18 to 25%. And that's why a lot of properties are coming back online. Owners don't know what they're doing, don't want to deal with guests, so they hire third-party management, and all of that income gets gobbled up by the management. At More Properties, we charge 15%. So it makes it viable for an owner to still do third-party management. But that is typically going to be your largest line item expense. The other large line item expense is property taxes. General utilities, electric, water, gas, you can figure out, but those are going to be your 2 big ticket items. When talking about debt, a metric that we often go to is the debt service coverage ratio. Typical lenders will require 1.0x. We try to find deals that can achieve a 1.5 or greater. So when discussing the DSCR, if I have a net income of $100,000 and I have my debt of $67,000, this is a 1.6 DSCR multiple. That would be a good deal. These are the 4 benchmarks that we do for very quick back-of-the-napkin analysis to evaluate whether or not it is a good STR deal. If you like what you've seen, please subscribe and find some more content on More Properties. Thank you.